And while there was bumps from Delta, the business came back very quickly when we got past that variant. We're anticipating the same thing with Omicron, that we will see some bumps in the recovery, and it depends. We're in 30 countries, we have 30 brands in 140 countries. So we'll see some bumps, but we don't think it's going to stop the recovery.
The FOMC could also begin raising the policy rate as early as the March meeting in order to be in a better position to control inflation.
For the first time in our history, the president had not just lost an election, he tried to prevent the peaceful transfer of power as a violent mob breached the Capitol. But they failed.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Liftoff in sight. James Bullard says the Fed could hike as soon as March. 10-year yields are set for the biggest weekly jump since 2020. The first jobs day of 2022, attention turns to payrolls data from the U.S. Plus, a long way down, Bitcoin continues to plunge, touching levels not seen since September. Now, first things first, I have to say it's all about the pay for, the non-farm payrolls, what it does to the markets and market expectation. This is a picture overall for the European stocks 600 down to 0.4%. It was interesting that the biggest laggards yesterday, i.e. technology stocks, that I have to say have had a real battering from the start of the year, today are amongst the biggest gainers. It's not a huge gain, but still some 0.2% higher overall. Watch out also for yields. They're becoming less negative in a lot of the European periphery countries. That could give a lift to some of certainly expectations of when the ECB will hike, putting pressure on equities. For example, the DAX down some 0.6%. Now, the big one to watch out for is, of course, U.S. Treasuries. We'll have a look at where Treasuries are at the moment, just to be careful on NFP rolls. I know we're expecting a big jump in terms of non-farm payrolls. The one caveat is that some people may not have returned to work or may not have looked at work because of Omicron. Let's also get to the European map to have a look at whether there's a difference between, the FTSE, for example, which is flat on the FTSE MIB, over in Italy, that's gaining 0.4%. The DAX, a little bit of pressure again. The DAX is also very cyclically rich in terms of the stocks that are on there, so that could explain some of the extra pressure that it's receiving today. But yesterday, it was really in line with everything else we were seeing. Now, this is the chart of the day. Without a doubt, I'm looking at Fed fund rates, I'm looking at Treasury rates, and I'm looking at what exactly the market expectation is. Now, I was also talking to Eddie van der Walt earlier, and he was saying, look, it is possible that the Fed was very, very bullish so that they can then pull off as being more dovish in 2022. That would be a good trick that would ease with some financing conditions. Certainly, this is what we're looking at. Look, since September and then that December meeting, we've had a repricing. So there's now an 80% chance of 2 or 3 rate hikes in 2022. So let's stay with the Fed. The St. Louis Fed President, James Bullard, says the Fed could start raising rates as soon as March and shrink the balance sheet next. Now, San Francisco Fed President Mary Daly also said beginning to taper asset purchases faster feels appropriate. We're now joined by Valentin Marinoff, head of G10 FX strategy research at Crédit Agricole, and Christina Kino from our Bloomberg Markets team. So thank you both for joining us. Valentin, are you going to change some of your views when it comes to equities if we have a very strong NFP roll?
Depends really on the number, obviously, but it is the case that if indeed the number is strong, and on the back of that, the markets continue to front load to more aggressive rate Fed tightening from here, that may indeed pose certain downside risks for the equity market, especially in the near term. Longer term, we still believe that the abating risk from the pandemic over the longer term, plus the fact that on the whole, the global economy is expected to continue to recover, that should paint a fairly still favorable backdrop for the global stock market, risk sentiment and all that. But in the near term, hawkish Fed, clearly a downside risk to the stock market.
Christine, we're excited about NFP, and actually there's a beautiful piece by Mohamed El-Arian looking at the Fed put. Now, this was our morning must-read this morning, and we kind of talked about, what his thinking was, is that the Fed is behind the curve, and so now they have a very small window to get it right. What's your take?
Well, yeah, I think that's going to be very interesting, Francine, because just the idea of the Fed now trying to make up for the lost time that Mohamed El-Arian was referring to is going to be really quite, would make for quite a turbulent time in markets, as we already saw this week. And so I think it's quite interesting in terms of the communication that they're going to have to embark on now, because if they are indeed kind of trying to sound hawkish without actually doing anything just yet, and then end up not living up to those expectations that they built up in markets, that's quite a communication U-turn and potential error that they're playing around with there. And, that's something that we saw with the Bank of England and UK rates markets as well last year. I'm not sure that that's something that the Fed would want to embark on, because that's definitely made things a lot more difficult for the Bank of England. So, yeah, the way they navigate this is going to be very interesting.
It is very interesting. And Valentine, I mean, they've been at such pains of making sure that there was no tantrum from the markets. Have they gone a little bit too far that the market now just won't correct enough?
Well, I guess as with many things, it remains to be seen. But as I said, they were very clear that they will be very transparent about what lies ahead. And it did feel from the minutes that were released in the recent speeches you've mentioned that the Fed was just trying to offer ever so gradually pieces of information about the true extent of their hawkishness from here. And I guess as the markets continue to absorb that, and depending on the reaction of the market, the Fed could go full-on hawkish from here. Clearly, the reaction function of the Fed will take into account what the markets make of the upcoming changes. What was also quite interesting in the minutes, I should mention, is the steps they're willing to take to keep the Treasury yield curve from flattening aggressively from here. And part of the story there is indeed the signal that a flatter Treasury yield curve, as the Fed hikes rates, could the signal that they're going to send to the market. So the attempts to keep the curve for essentially from flattening too aggressively by using runoff quantitative tightening is also part and parcel of that strategy to keep the market going, to keep the recovery going, even as they remove accommodation. That said, it's not going to be a straight line. I think it's a sort of not trial and error, but I think the Fed will try to see how the market is responding and then take it from there.
Christine, I mean, something that caught both of our eyes is basically also Goldman Sachs seeing this new conundrum capping Treasury yields that have been surging. And then we spoke to, HSBC Stephen Major, and he says, well, this is not a prediction. This is already happening.
Absolutely, Francine. Of course, you can count on Stephen to be a perennial bond bull, right? But no, I think Goldman makes a really interesting point. The fact that despite the gyrations and the surge in yields that we saw this week, it's important to remember that it's still well below the Fed's terminal rate, right? This is the balance between inflation and growth. This is their optimal rate that tells you, everything is in perfect balance. And so the fact that yields are still expected to be well below that does tell you about the extent of tightening really that we can expect from the Fed and the context in which it's happening. Yes, it's going to be quite fast, especially and quite the change from a long era of super easy monetary policy. But still, the fact that it's below that terminal rate tells you that financial conditions may not be as tight as some people are anticipating.
Thank you so much, Christina Aquino from our FX and rates team, Valentin Marinov from Crédit Agricole. Both stay with us. Now, in the meantime, we're also looking at GameStop. We had a wonderful briefing on GameStop, but the fact that they're going into NFTs, kittens NFTs, is what the people demand. Those shares rising 21% in U.S. pre-market trading. That's on the NFT plan. I mean, look at that. It's pretty incredible, actually, getting some 19.5%. Coming up, as mentioned, meme stock darling GameStop soars on its plans for an NFT marketplace. We'll bring you the details of that. Plus, we'll talk growing demand for alternative meat and the future of food with Jim Mellon from Agronomics. That's a little bit later on in the program. This is Bloomberg. President Joe Biden actually blaming Donald Trump directly for the insurrection at the U.S. Capitol a year ago. Now, Biden in the building Statuary Hall, it was actually marking the first anniversary of the insurrection. I think we can hear from the president.
For the first time in our history, a president had not just lost an election, he tried to prevent the peaceful transfer of power. He refused to accept the results of an election, created and spread a web of lies because his bruised ego matters more to him than our democracy or our Constitution. He can't accept he lost. He's not just a former president. He's a defeated former president.
Now with your Bloomberg First Word News, here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Health Organization says while the Omicron variant may appear less serious than previous strains, it should not be considered mild. The WHO says global cases soared a record 71% during the week to January the 2nd, while deaths rose 10%. Actual case numbers are expected to be much higher. Now, that's due to underreporting. Kazakhstan's president has declared that order has largely been restored following efforts to crush mass protests that erupted over fuel prices, leaving dozens of people dead. Russia and its allies dispatched troops to quell demonstrations that pose the biggest threat to Kazakhstan's leadership since independence back in 1991. And China's Delta variant-fueled COVID outbreak is not showing signs of easing, with cases now cropping up elsewhere in the country, despite a drop-off in recent epicenter Xi'an. The National Health Commission has reported 116 new domestically transmitted cases for the previous day. Tech hub Shenzhen has discouraged people from leaving the city after announcing 2 new infections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, Germany preparing to tighten access to restaurants and cafes to help rein in the spread of the Omicron variant. Weekly case numbers have crept back above 300 per 100,000 people. Globally, cases have now climbed to more than 300 million. The latest figures out of Germany and France show industrial output in the region's 2 largest economies shrank unexpectedly in November due to supply constraints. Well, Valentin Marinov from Crédit Agricole is still with us, as well as Christina Kino from our FX and rates team. Christine, thank you both actually for joining us. But Christine, we've been talking about negative yields and actually the fact that they're less negative and actually going positive in certain parts of Europe. What does the ECB do in 2022?
Well, that's the big question, isn't it, Francine? I mean, the ECB now, because of what we saw with the shift in markets expectations in the Fed aftermath, definitely a lot more attention turning to what the ECB is going to do, because arguably it's kind of one of the last holdouts in terms of keeping its deposit rate very, very low. In fact, I think it's still negative, and very much far away from embarking on the tightening path that the Fed and the BOE are starting to go on. And so, but we are seeing those expectations getting built up for at least a small rate hike from the ECB by the end of this year or early 2023. And so it may just be a matter of time before those expectations get ramped up and force the ECB's hand in some way.
Valentin, I mean, my chart of the hour was, until 2 minutes ago, what we're seeing with the possible Fed hikes in 2022. But look at this fact. I mean, this fact, I think, is probably, underpins everything that we're trying to do on Bloomberg today. The last time that German inflation was at 5.3%, the Bundestag key rate was 8.6%. So actually, how much pressure is the ECB under right now?
Well, I do think that the pressure is there, and I think that the pressure is likely to grow from here, especially as the output gap in the Eurozone starts closing by mid of this year, as the Eurozone economy is fully reopening in the second half of the year. So I think that the ECB will have to start preparing the markets for rate hikes into 2023, maybe the end of this year, maybe a bit too early for them. But importantly, the ECB will continue to face 2 conflicting objectives. They'll try to prevent a meaningful overheating in the economy, but at the same time, they also want to maintain very favorable financial conditions. That's so important for the periphery, where we saw that massive build-up in debt during the pandemic period. So from that point of view, I think that one potential solution to that dilemma, if you wish, is to certainly reduce or hike rates, if you wish, but at the same time, continue to reinvest the proceeds of your portfolio, so essentially you continue to offer solid backdrop for the ECB market. So I think one result of that could be a stronger euro, because I think as a result of that, the rate disadvantage of the currency will gradually start abating. And at the same time, any credit risks associated with renewed sell-off in the Eurozone periphery will be mitigated as well.
But Valentine, is this discounting some of the political risk that we could see from Europe, i.e. the French presidency could bring up surprises, as well as Italy with Mario Draghi possibly being touted to become president?
Yeah. Well, of the two, I think that the focus should be on the Italian presidential elections. I mean, the French presidential elections may be lively, but ultimately we think it's going to essentially reaffirm the status quo with President Macron re-elected, in our view. In the case of Italy, we do think that if indeed Prime Minister Mario Draghi becomes Italy's new president, Draghi, that may open, potentially increase the risk of even snap elections. And looking at the polls in Italy, we do have the center-right populist party still in the lead, if you think of a coalition there. And that could put a question mark over the relationship, again, between Italy, the EU, Eurozone, European Commission, and that may not be really such a positive outcome for the BTP market, obviously for the euro. This is why it's quite instrumental that the ECB remains, the buying really by the ECB remains in place for the time being and going forward, because we do need that backdrop, if you wish, a credit backstop of sorts, that will make sure that credit risks in the Eurozone do not escalate again.
Yeah, so we actually, in terms of the biggest repricing, it could also be in Europe in general, also with equities.
Absolutely, Francine, because I think this is where the expectations really aren't baked in at all for potential speedier ECB tightening. And, you know, much like what we saw from the Fed this week, there's definitely a lot of room for that pricing to ramp up as well. And yeah, I think so many risks coming for Europe for sure. I mean, we still have the argument, of course, that Europe is, you know, it could be the time to shine, given that it is value heavy, but we haven't seen that play out. We'll see if 2022 will be the year.
We have been saying it for a long time, so maybe this is the year 2022. Thank you both for joining us. Valentine Marinov, head of G10 FX strategy at Crédit Agricole, and Christina Kino from our FX and rates team. Now, coming up, we'll bring you the latest on all things autos, including this. Look at BMW's new color changing car. It's pretty cool. I'd be concerned of scratching it, but this is a BMW that turns from black to white. It's a technology developed with a company, E-Ink. I mean, it's actually quite amazing what you can do in 2022. So look at some of the cool, weird, and wonderful things in the world of tech. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Rivian closed at the lowest level since it started trading in November amid the prospect of growing competition in the EV market. Now, the move extends a drop from Wednesday when Amazon actually announced a deal with rival Stellantis to buy electric delivery vans. Well, elsewhere in the auto space, you may also soon be able to change your car's color with the touch of a button. I mean, this is one of the coolest things I've seen this week. BMW debuted a concept vehicle with a company called E-Ink to develop the application for its vehicles. Now, to talk about all of these cool things, our autos editor in Germany is Stefan Nicola. Stefan, first of all, good morning. So what does the year look for Rivian after this pretty disappointing start to the year?
Yes, good morning. Well, so yeah, the announcement wasn't too great for Rivian. It will be key for this EV startup that it can really ramp up production of its EVs. You know, Rivian has a lot of orders, but it needs to prove that it can actually mass produce these EVs so that Amazon will take off more of its delivery vans.
So, but Stefan, overall, are you expecting a repricing? So Rivian, you know, when it IPO'd, people are like, wow, this is really just on Amazon. So they're so dependent on Amazon. Are we going to see more entrants in the market?
There will definitely be more competition for Rivian down the road. I think it will be key for the company to also broaden its lineup of buyers. It can't be reliant on Amazon all the time. And for sure, there will be the traditional car makers will also try to grab a piece of the electric van delivery market, and Amazon is a huge customer. It will need more vans, that's for sure.
Yeah. Stefan, I don't know if I'm an 80s child, and I remember the mood color rings that used to change color depending on your mood. I mean, that BMW car, I don't know if it's like a mood car, but it's pretty cool. Is this the technology that people will want to have, and does it have any functions beside changing color?
Yeah, I'm an 80s child as well, and it certainly looks fun. I'm not sure if this technology will go mainstream anytime soon, but it's quite a cool feature. And what I think is sure that down the road we will see more personalization of cars, as we've seen in other product trends. So BMW has just debuted this concept car that really gives us a first peek into the future of what cars may look down the road.
Okay, amazing. Stefan, I'm so happy to hear you're an 80s child. We need to do like a best of, the things that we had back then, like the wristband that used to slap. Anything else that comes to mind? Yeah. It's all about tie-dye. Always comes back. Stefan, thank you. Stefan Nicola there, our European Autos editor. Now, coming up, we get back to the U.S. economy and the Fed on the first jobs day of the new year. This is Bloomberg. Liftoff in sight. James Bullard says the Fed could hike as soon as March. 10-year yields are set for their biggest weekly jump since 2020. The first jobs day of 2022, attention turns to payrolls data from the United States, plus a long way down. Bitcoin continues to plunge, touching levels not seen since September. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The focus firmly on what we're seeing, of course, ahead of NFPs. We did have a bit of a risk reversal over the last couple of days. Treasuries not really moving by that much. We've had a number of banks saying maybe things continue to be dispriced. At some point, we'll have a tantrum, and European stocks, you can see, down some 0.2%. In a couple of seconds, we're also getting some UK PMI numbers. That will be significant for the Bank of England. Again, the Bank of England will also be determined by what the central bank of, the Fed does over in the U.S. March contracts, for example, for the technology hub at NASDAQ fell some 0.4%. And then I'm looking at weaker dollar gains for emerging market stocks, signaling some of the risk-taking had returned after a pretty turbulent earlier start to the year. You can see pound currently at 135.46. UK December construction PMI falling a touch, but pretty much in line with what was forecast. So it's the first jobs day of the year in the U.S., and ahead of those numbers, the St. Louis Fed president said the Fed could lift off as soon as March.
The FOMC could also begin raising the policy rate as early as the March meeting in order to be in a better position to control inflation.
Well, HSBC's global head of fixed income research, Stephen Major, also weighed in on inflation.
One of my colleagues has told me there's a sort of a bungee effect or a reverse bungee on inflation. It's gone up a lot, but it's going to come down sharp and it could bounce again. So that's a forecaster's nightmare. But I don't know how anyone can be so sure about anything right now.
Well, we're joined by Sarah Hewin, head of Europe and America's research at Standard Chartered. Sarah, thank you so much for joining us today. What are you expecting from non-farm payrolls?
Well, I'm very hesitant to be precise because we know that payrolls can bring in surprises with each report. We are looking for a strong 500,000. I think we've seen consensus moving up towards our view. We've had some pretty solid activity through December. And in the last few months, we've seen the sort of household survey catching up with payrolls. And we think that we'll probably see payrolls doing well this time. Now, the question is, what about Omicron? Because we think that that is going to have an impact for the January report. The December survey was carried out sort of early mid-month, around the cusp of when hospitalizations and cases were starting to pick up. And as we know, since then, they've absolutely skyrocketed. So there will be an impact on employment from Omicron. But we think that we probably won't see that reflected in the December data today.
Sarah, I mean, and I don't know whether you think actually the Fed missed the boat last year, but is it possible that they're being a lot more hawkish now, says that they can get away with actually 2 interest rate hikes, cool the markets, so still be dovish, and they do the trick that way?
Well, we're expecting that they will go for the first rate hike in March, and we think that that will be followed by another rate hike in June, and then we see them on hold. The inflation profile, clearly they're very concerned about inflation. The worries about Omicron seem to be focused on supply side pressures, which also potentially are inflationary. So we think that they're going to be moving quite swiftly in the first half of this year, but we expect that inflation is going to be falling quite sharply in the second half of this year, and potentially by 2023 will come in below target. So that at that point, we think the Fed will pause and just see how the economy evolves and what happens to inflation.
I mean, if we have strong wage data, actually as part of the payrolls report today, does the market reprice a lot of their expectations?
Yes, I mean, strong earnings are the real issue here, because we know that we've seen energy prices down from their peaks. We've seen freight prices down from their peaks. A lot of these costs, a lot of these input costs are already starting to ease. We know by the second half of next year, probably the chip shortage will be easing back as well. So the question is, does current high inflation start to get embedded in the economy via high wage awards? Now, we're expecting 0.4% month on month for wages on an annual basis. That comes down because of base effects. But we have seen particular growth in wages in lower paid occupations. So if we see a strong payrolls number, then there are upside risks to the earnings outlook as well. Conversely, if it is the case that Omicron has had an impact on the employment data, then there's likely to be a more than outsized impact on earnings as well, given that it will be low-paid workers who would be most affected.
Sarah, what's your take on actually what dollar does from here, and how significant will that be, for example, for all the commodity-rich countries?
Yeah, I mean, dollar is likely to get some support from these market repricing the Fed expectations. If we're right that the Fed moves in March and in June, then that's sort of more aggressive than market had been anticipating up until recently. But we see over the medium term that dollar is likely to come under pressure if we're right that the Fed then pauses. Obviously, you have the FOMC, you have markets already incorporating at least 3 rate hikes for this year. And if we're right that they can do 2 rate hikes and then pause, I think that will take some of the steam out of the dollar, and we'll see a sort of lift in other currencies.
Sarah, when you look at some of the misnomer out there, some of the things that are being mispriced, do we need to look at Europe for maybe some of the biggest risks out there? We're seeing yields creep back up in Europe, possibly not being negative anymore, but not much is being priced into what the ECB does.
Yeah, I think that there are some risks of mispricing there. Now, there's a very clear message from the ECB that inflation is not a problem. They're still using the transitory term, which has obviously been retired by the Fed. We're not yet seeing inflation pressures picking up. I think the caution here, though, is what happens to wages and salaries across the region, because we do see collective bargaining and a potential for more long-lasting and entrenched wage agreements coming through later in the year, which would clearly send a signal to the ECB that inflation actually could be on target rather than below target over the next in 2023 and 2024. So that may well end up bringing forward the first hike to the deposit rate. At the moment, we're not expecting that until later in 2023, but I think that, there are risks around that expectation.
Sarah, thanks so much. Sarah Hewin there, head of Europe and America's research at Standard Chartered, joining us this morning. Now, coming up is plant-based meat finally going mainstream. We'll look at the future of food with Jim Mellon, executive director at Agronomics. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. European chip maker ST Microelectronics has posted fourth quarter revenue above outlook. Revenue for full year 2021, meanwhile, rose 25% on the previous year as the company benefited from a robust demand for chips. Persistent shortages of semiconductors have continued to stunt growth in industries such as car making and consumer electronics. Now, Samsung's quarterly profit has climbed more than 50% after chip prices stabilized and sales of smartphones surged, reinforcing hopes the memory industry will emerge from its downturn. South Korea's biggest company has a key plant in the Chinese city of Xi'an, which is under a strict lockdown. Analysts say short-term disruptions could dampen supply and lift chip prices. Hotel operator Marriott International says it is optimistic about the travel industry's recovery, despite a recent surge in COVID-19 infections. Speaking to Bloomberg, the company's president acknowledged challenges posed by the Omicron variant, but says the rebound does remain on track.
And while there was bumps from Delta, the business came back very quickly when we got past that variant. We're anticipating the same thing with Omicron, that we will see some bumps in the recovery, and it depends. We're in 30 countries, we have 30 brands in 140 countries. So we'll see some bumps, but we don't think it's going to stop the recovery.
And Bank of America is encouraging U.S. employees to continue working remotely through next week as it monitors a surge in COVID cases. An internal memo also encourages staff to get fully vaccinated and obtain booster shots. It joins Goldman, JP Morgan and other Wall Street firms rethinking New Year return to office plans. The World Health Organization says while the Omicron variant may appear less serious in previous strains, it should not be considered mild. The WHO says global cases soared a record 71% during the week to January the 2nd, while deaths rose 10%. Actual case numbers are expected to be much higher due to under-reporting. Now, Kazakhstan's president has declared that order has largely been restored following efforts to crush mass protests that erupted over fuel prices, leaving dozens dead. Russia and its allies dispatched troops to quell demonstrations that pose the biggest threat to Kazakhstan's leadership since independence back in 1991. China's Delta variant-fueled COVID outbreak is not showing signs of easing, with cases now cropping up elsewhere in the country, despite a drop-off in recent epicenter Xi'an. The National Health Commission has domestically transmitted cases for the previous day. Tech hub Shenzhen has discouraged people from leaving the city, and that's after announcing 2 new infections.
All right,
back
Leanne.
to you, Francine.
Leanne, thank you so much. We'll have plenty more, of course, on all of these stories. We'll look at Bitcoin. We'll also look at rejuvenation and some of the things in agriculture, the very cool things that vegans especially like. This is one of the biggest frontiers coming up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Yum Brands will start selling plant-based chicken made by Beyond Meat in its KFC restaurants across the U.S. from next week. Now, many of the world's biggest fast food retailers are starting to offer plant-based options. Consumers are becoming increasingly worried about emissions caused by rearing livestock. And according to the UN's Food and Agriculture Organization, cattle produce by far the greatest amount of greenhouse gases of any meat. Now, for more on this, we're joined by Generale. He's Executive Director at Agronomics, a UK-listed company that invests in cellular meat space, and chairman of the private investment company Bird Bay Group. Now, Jim's book, Moo's Law, published in December 2020, also provides an investor's guide to the new agrarian revolution. Jim, thank you so much for joining us on such an important topic. So first of all, how easy or difficult is it to model how much more of these products we'll eat? So how much less meat will people eat in 10 years, and how many more plants do we need to plant to make sure that we make up for that?
Okay, so all the meat that we'll be substituting for conventionally farmed meat won't come from plants necessarily. Quite a bit of it will come from cell-cultured processes, which don't require plant inputs. So at the moment, Francine, we estimate that in about 10 years' time, approximately a third of the world's meat market will be either plant-based or cell-cultured. That almost all of the world's dairy market will be what's called dairy identical, which is dairy products made with precision fermentation without recourse to cows. So the big cow herds that we're familiar with will be gone within 10 years. And that the fish market will also be disrupted. And on top of that, you've got all the materials like leather, collagen, and so forth that are now being made in laboratories as well that will significantly disrupt those industries. So it's a very remarkable change that's coming.
So, Jim, it is, I mean, if you look at the numbers and if you believe the numbers you're saying, I mean, it's a huge change. What do we need to accelerate that? Is it the technology? So should investors go in through the technology aspects of people that find how to make this? Or is it just the producers?
Yeah, great question. So basically, you've got most of the companies that we've invested in already have products that you can eat or taste or feel or whatever. And the question is scale. So the scale is the big challenge. And that will require huge amounts of investment. We estimate that in order to get to about a third market share for cell-cultured and plant-based meats alone will require a capital investment of about $1.8 trillion in the next 10 years. So this industry is ramping up, very, very quickly from very small beginnings. But the total addressable market of all the stuff that we've just talked about is bigger than, for instance, the whole car market. It's about a quarter bigger than the whole car market. It's about $5 trillion. So the prize is very big indeed.
I mean, the prices are big. Where do investors look for some of these companies? Is it in Europe? Is it in the U.S.? Is it Asia that's at the forefront of this?
Yeah, so the U.S., as usual, is at the forefront, but Europe and Israel are catching up, and indeed also now in Asia. So it's pretty well dispersed across the globe, but it comes largely from the U.S. To begin with. And some of the products are already on sale. So Vitro Labs is selling its leather as luxury leather to luxury producers now. Perfect Day, which is a dairy identical company making whey and casein in lab conditions, has served over 1 million customers already and has just done a deal with Starbucks as an example. And you've got some meats on sale. So Super Meat is on sale in Israel, and in Singapore, you can buy Just Eat chicken nuggets. So the money is coming in quite rapidly. It's doubling every year. And the technology is here and now, actually. It's just a question of scale, hence the name of Moo's Law for my book.
Yeah, I mean, it is a question of scale. The other question is, how do you make sure that some of these new technologies aren't as bad for the environment as actually eating meat? And how long does it take to realize, once you have a technology in place or you start producing fake meat in one form or another, how do you make sure that actually it's not detrimental to the environment, for example, and where you produce that crop?
Yeah, a very good point. So plant-based meats are one thing, and obviously deforestation occurs to grow crops, some of which go into plant-based meat. So it's not necessarily much better for the environment. In terms of dairy products, methane gas from dairy cows is the biggest emitter of all. And I'm very pleased to say that we expect that the dairy industry will be completely upended. In terms of cell culture, it uses about 1% of land, about 7% of water, 50% of energy, and about 1/10 of the inputs in the case of producing beef than is required by conventional farming. So in every environmental box, it ticks the zeitgeist extremely well. We expect that the meat produced in labs, which is not the meat produced by plants, but is real meat, just produced in a different way, it's a different type of factory, will be cheaper and healthier because it doesn't use any antibiotics or any hormones, healthier for human beings, and ultimately cheaper because the input ratios are so much lower than what animals consume in order to put out their bits of meat, basically.
I tried one, Jim. I think I can't remember if it was with you, but I remember being actually on set with a guest and trying it. So we'll have to get you back. The other craze is insects. So we'll see whether you get into that. Jim, thank you so much. That's all we have time for today, but we have to get you back also in the studio in London. Jim Mellon, Executive Director at Agronomics and Chairman at Brumbay Group, also the author of Moo's Law. Now, not long after some calls that it would be reaching $100,000 by year-end, Bitcoin has continued a weeks-long drop this morning, falling to a September low. Elsewhere on the blockchain, GameStop, one of the last year's biggest meme stocks, says it's getting into non-fungible tokens business, and Bloomberg has learned of its plans to launch a marketplace for NFTs, causing its shares to surge in extended trading. Well, joining us now is our markets wizard, our Bitcoin wizard. He's a wizard, full stop. Eddie van der Walt from our MLive team. Eddie, what do we actually know about GameStop's plans, and why are they proving to be such a boost?
Look, GameStop's certainly pulling out the magic here, right? I think GameStop, what we know, and it's a great story from our colleague Olga Karif, who says that they're trying to launch a marketplace for NFTs, and they're currently talking about, you know, which cryptocurrencies should be included in this, and then also, I think probably as the backbone for that, looking at a fund that might buy some cryptocurrency. So really interesting space. But I think this is just smart from GameStop, right? Because they are trying to do a pivot to a more digital presence rather than their traditional bricks and mortar presence. And I think this buys in, and it will resonate with their core investors who are very savvy, very young, and very interested in the crypto and NFT space.
Talking about Bitcoin, I mean, the price, crumbling below that psychological level of 42,000, what's driving it? And does it mean that another cryptocurrency will take over?
You just never know with Bitcoin, right? I mean, yes, it can go to 100,000 this year, even so, but it could also go to 20,000. The volatility is spectacular, and that's feeding through into the rest of the cryptocurrency space, with Ether and the other cryptocurrencies also suffering. But I think institutional investors got on board last year in a big way and gave Bitcoin a lot of momentum. Now this year it's going to be harder to sustain that momentum because we've already seen that adoption. So I think Bitcoin is at a bit of a crossroads. It depends on who, how much new money flows into the space.
Ed, I don't know whether you're a betting man, but in 20 seconds, Treasury slipping before the NFP data. Do you think they'll beat?
Do I think the what will beat?
NFP. The NFP numbers will be better than expected.
Oh, the NFP numbers. Oh, it's very hard to say. I mean, look, I think there's so much optimism baked into NFTs after that ATP number that it's really hard to say. But yes, I think so. Possibly, disappointment this time.
Eddie, thank you so much. More Bloomberg Surveillance next.
And while there was bumps from Delta, the business came back very quickly when we got past that variant. We're anticipating the same thing with Omicron.
The FOMC could also begin raising the policy rate as early as the March meeting in order to be in a better position to control inflation.
For the first time in our history, the president had not just lost an election, he tried to prevent the peaceful transfer of power as a violent mob reached the Capitol. But they failed.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, January 7th. Our top stories today. Did the experts get it right? It's Jobs Day in the U.S., and our survey says that payrolls grew more than twice as fast in December as the month before. Markets are primed for a big jobs number. Investors look for signs that more Americans are returning to the labor force at a time when there are a near record number of openings. And showdown at the Supreme Court. Justices will hear arguments over President Biden's push to vaccinate millions of workers. Business groups are Republican and Republican-led states are opposed. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Danny Berger, also here in London. Kailey Leinz is with us in New York. Matt Miller is off today. And Kailey, it's a really interesting session, isn't it? Usually we see European equity markets pretty flat on Jobs Day. Today we've had quite a lot of movement, some of that to the downside. And we're waiting to see what kind of response we get in Treasury markets. There's been so much volatility there this week to that jobs report.
3.5 hours to go until that jobs report, Anna. And I think the market reaction is going to be really interesting because if we get a good number, does that just solidify expectations that the Fed could lift off in March and therefore be a bad thing for risk appetite? We will see. Risk appetite, though, was definitely there in the Asian session overnight. The MSCI Asia Pacific Index up about 0.4%, and Hong Kong was really the outperformer. And there's two sectors in particular I would point to in Hong Kong. One being technology, the Hang Seng Tech Index up about 2%, continuing a technology rebound in Asia. And then the Hang Seng Property Index also was higher by about 2.5%. And that is after China encouraged banks to provide more loans to the property sector, easing up some debt restrictions for that sector. So that's providing a bit of a lift to sentiment. I also wanted to note, speaking of sentiment, the Japanese yen, because of course it hit its weakest against the dollar since 2017 earlier this week. This morning, though, little change, trading around 115.83. Now, when it comes to the U.S. session, of course, we really are all just waiting and watching for that jobs report. So we'll have to see how things shake out at 8:30 a.m. Eastern time and what happens in the future session at that point. To this point, equity futures are trying to gain somewhat of a footing, and that is particularly true for technology, with the NASDAQ 100 right now on pace for its worst week since October. Those futures right now are basically little change, just slightly in positive territory. In the bond market, we are seeing yields climbing higher for a sixth day in a row. We're up about a basis point on the 10-year Treasury yield, just under 173 at this point. And then crude also has been something to watch this week. WTI gaining at least 1% every single day. It's around higher by about that much this morning. We are back above that $80 a barrel level, but it's not as good of a story for Bitcoin, Danny. We are now almost 40% below that record hit in November. It is trading closer and closer to that $42,000 level, Danny.
Yeah, maybe an awkward time for those calls of 6 digits on Bitcoin. Kailey, I first want to bring us some breaking lines that just crossed over euro area inflation, coming in with that dreaded 5 handle. 5%, the estimate was for 4.8%. So it's a lot for markets to digest this morning, and so far moving lower for the second day in a row. Most of the regional benchmarks moving lower. Underperformance from the DAX down about 0.4%. Some outperformance from the FTSE MIB, that's up 0.4%. UK stocks, little change. But overall, this is a benchmark that's moving lower today. It is headed for a week-over-week lower number, despite the fact that it was trading at all-time highs just a few days ago. Now, it really is the bond market that sets the pace for European equities, really for equities global. And those types of inflation numbers are surely not going to make investors want to go into bonds. We continue to see selling across most of the space. We're looking at a German 10-year bond that's its closest to zero since May 2019. With these hot inflationary numbers coming in, how long can the ECB wait? Will they have to hike? I should note Italy also the brunt of the selling. The spread between these two have expanded by 30 basis points since mid-October, because Italian debt especially vulnerable to any sort of economic woes. Finally, Anna, part of the reason that Italy was outperforming in terms of the equity session, STM Micro up 5.5%. They had their preliminary earnings, some very strong numbers. We also heard from Samsung. So chip makers, a little bit of a reprieve, especially because we have the shortage and, of course, these high-value tech stocks, especially vulnerable to move higher in yields.
Yeah, interesting to keep watching that sector. To what extent can it invest and keep delivering the capacity and not find itself in an overcapacity situation in the future? Certainly a concern for the sector. Let me just flag, you mentioned the Eurozone inflation data that we had out. It beat estimates, Danny. We saw a very slight tick up in euro and also Bund yields as a result. I only mention because there's a lot of focus on that Bund yield as it edges slightly closer back up to zero. Could it be positive anytime soon? Now, a look at what is ahead for us today. EU Commission President Ursula von der Leyen is in Paris, along with other EU commissioners. She's already met with Emmanuel Macron this morning, the French president, to officially kick off the French presidency of the European Union. There will be a NATO foreign ministers meeting at 8 a.m. New York time. The Secretary General is expected to brief the press afterwards, and that comes ahead of a Russia-US meeting in Geneva this weekend. The US Supreme Court will hear arguments on President Joe Biden's COVID-19 shot or test rule for large employers and his separate mandate for healthcare workers. More on that shortly. And it's US Jobs Day. Bloomberg Intelligence expects the report to show a solid pickup in December hiring. Let's get more on the US jobs report that still lies ahead for us this Friday. Michael McKee joins us, Bloomberg economics and policy correspondent. Mike, very nice to have you with us. So set us up for the number that is to come. I suppose one of the big questions here is there going to be any noticeable Omicron effects?
Probably not. There may be some other impacts that we want to watch for, but Omicron didn't take off until later in December. The survey is taken in the week that includes the 12th of the month, so we were only getting started then. But we do want to see if we did get a solid gain in services hiring as we went through the month. That's what the ADP report suggested. And that's why we've seen the change in payrolls forecast move up to 447,000. It was 424,000 earlier this week. We started the week at 400,000. And as you can see, we're watching average hourly earnings. Are they going to turn up instead of dropping, as the forecast says? John Authers has a column on the Bloomberg today suggesting we could see a bond market tantrum if we get a little more wage pressure than the market expects.
Well, and obviously the market's going to be wondering what these numbers translate to in terms of what it means for monetary policy. If the report is strong, if wage growth is strong, Mike, does that solidify a March liftoff for the Fed?
It will go a long way towards that, and you have Jim Bullard already suggesting that they could do that. They will have one more report before their meeting in March, but January we should get a strong signal from the Fed that they are prepared to move as soon as possible. One of the things that happens when they move is that the market tries to anticipate that. So we could see yields moving up, and I know you were talking about the German Bund. It could move more towards zero as the U.S. 10-year starts to go higher, and we'll see how the whole world reacts to this number today.
Yep, certainly the whole world is waiting for it. Mike, thanks so much. That's Bloomberg's Mike McKee. Now over to Washington, where the fate of President Biden's push to vaccinate millions of workers amid the latest COVID-19 surge hinges on a Supreme Court showdown today. Emily Wilkins, Bloomberg government reporter, joins us now. Emily, this really has been the backbone of Biden's plan to help cope with a surge in cases. So what's at stake here with the Supreme Court decision?
Well, what's at stake might be exactly how many Americans are able to be vaccinated and what that could mean for the future of the U.S. in terms of economic, social life. There are two different cases the Supreme Court's going to be considering today. One deals with healthcare workers needing to get vaccinated if the groups they work for receive federal funding. The other deals with a rule that's supposed to be enforced by the Department of Labor, requiring that companies with 100 or more employees either require their employees to get vaccinated or to regularly test. And this has gotten pushback from a number of companies as well as states who have said that these rules are overreach. The Biden administration has said that these rules are necessary at this time because of the pandemic. And it kind of goes along with this longer struggle that the White House is currently having, how to make sure that Americans get vaccinated. Right now, only a little more than 62% of Americans are fully vaccinated. Only about a third are boosted. And this has really caused some headaches for Biden trying to get the nation to move beyond the pandemic.
So obviously, Emily, the White House is going to have one eye on the Supreme Court today. Also probably going to have one eye, as always, on the Capitol building just down the street. We heard a lot yesterday, especially in President Biden's speech on the anniversary of January 6th, about voting rights legislation. Is there a feeling this morning that that is something that could imminently be coming and be passed by Congress?
It's something we know that Congress is going to be focusing on next week, particularly in the Senate, as they have tried and failed multiple times to pass voting rights legislation. But really, there's a huge question mark. What, if anything, can be done at this point? It really does seem like if you want to get something done with voting rights, you're going to need a rule change that's going to allow it to pass with fewer than 60 votes, because they don't have those 10 Republicans right now who will join with Democrats on this. And there's been a lot of change about potentially changing the rules, but at this point, it's their usual culprits, Senator Joe Manchin, Senator Kirsten Sinema, who say they're not comfortable doing that at this time. It's, I think, going to be the big focus of next week, and something we're going to have to see exactly how Senate Majority Leader Chuck Schumer tries to maneuver here.
Emily, thank you very much. Emily Wilkins of Bloomberg Government with the latest on politics stateside. Let's dive into what's going on in China and the property sector there, because China called on banks to boost real estate lending in the first quarter and eased a key debt restriction for developers, a sign perhaps that authorities are becoming increasingly concerned about the industry's liquidity crisis. Bloomberg's Tom McKenzie joins us now for more. Tom, help me understand what's going on here, because I thought there were concerns about too much debt in the property sector. I thought that was why we were seeing the government clamp down on it, and here we have them pushing in the other direction.
Yeah, it's a concern. It's obviously highlighting that policymakers are trying to engineer a soft landing, and you're right, this is going to be tricky for them. Where do you engineer, where do you channel that lending? They want the money, they want this credit to go to the stronger developers, and this was interesting from this. Yes, they are leaning on the banking sector overall to increase lending to the real estate sector, but specifically they moved the restriction around lending for M&A, for acquisitions, because they want the stronger developers to help hoover up the soured assets of those weaker players like Schumau, like Kaiser, like Evergrande, of course, notably. Also unreported previously, our team in China doing a great job. Back in December, the authorities, regulators offered window guidance, again, to the banks to step up lending to the overall property sector after 2 straight quarters, at least 2 straight quarters of falling lending. So it's clear they're becoming concerned about their liquidity squeeze. They want the money to go into the right places. They want these assets to be absorbed. Larry Hu from Macquarie saying, these measures are marginal for now, but it probably spells the end of the tightest period of this years-long regulatory squeeze. He sees additional stimulus for the real estate sector coming in the middle of the year.
Yeah, all about that soft landing. Tom, thank you very much. That's Bloomberg's Tom McKenzie. Now let's get a look at some of the stocks that are moving in the pre-market trade in the U.S. T-Mobile reporting earnings yesterday. They did top estimates. However, they warned of slowing growth this year because the era of a frenzy of signups over a lot of free promotions in the industry is coming to an end. So flagging that, sending shares lower by 1.4%. Now, if you are stuck in New York currently and you're dealing with the snow and you're bored, a new option for you is betting on the Super Bowl on your phone. This is a new regulatory measure passed by New York. DraftKings, among 3 other companies, now can do this, now can offer this. It rallied about 4.7% on the news yesterday. That rally is continuing in the pre-market session this morning, up 2%. And finally, GameStop, really the big pre-market mover. It is a meme turducken of a meme stock offering NFTs. GameStop, according to sources, looking at a NFT marketplace. That news sending the shares surging by 18.3% pre-market. And apparently they're already in talks with different crypto companies, different blockchain companies to see what kind of tokens would be offered. Because, you know, why not? Every company, I think at some point, is probably turning into an NFT marketplace at this rate.
Well, yeah, why not? Diamond hands and everything. It sounds so 2021, doesn't it? I mean, if you had an algo running looking for the words GameStop and NFT in the same sentence, you know, happy days. Coming up on this programme, then, we're going to be talking about that jobs data, looking ahead to it further with Klaus Baader, Chief Economist at Societe Generale. What will he be looking out for in this release? How much does it matter to the Fed, given that many on the Fed have said they're not waiting for full employment to hike rates? And we may be done with the pandemic, but it isn't done with us yet. Those are the words of Eurasia Group. We'll speak to advisor Scott Rosenstein about the fight against COVID, specifically around China. A really interesting conversation to come there. Plus, we'll get the Biden administration's view on the U.S. jobs report from U.S. Labour Secretary Marty Walsh. That's at 10 a.m. New York time, 3 p.m. here in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. Now, European equities are on track for their second day of losses, getting swept up in the pain of equity markets due to a Fed that turns more hawkish. But how long will that last? I want to welcome our radio listeners, specifically because I have a chart in front of me. I know you can't see it, so I will explain it to you. I'm looking at three indices here: Stock 600, S&P 500, and the FTSE 100, and at their forward PE ratio. Now, of course, these metrics track each other pretty closely. However, the S&P 500 is much more expensive than the FTSE 100 and the Stock 600 as well. So if you're concerned about rates going higher and the impact on high-valued stocks, is Europe a place you want to hide out? Well, joining us now is Ksenia Galuchko, who leads our coverage of EMEA Equity Services. Ksenia, what is the growing consensus on the attractiveness of European equities in this rising rate environment?
So the appeal of European equities is rising with every day, especially this week, now that we've seen this major sell-off in the Nasdaq, and tech stocks are very quickly falling out of favor because of the fear of rising rates and the Fed being more hawkish than expected. This is where the European market comes in with its very generous selection of cheap value stocks and also cyclicals. So this week alone, I mean, it's a crazy start of the year, but we've been seeing autos, miners, banks being some of the best performers. And also, it's a rare case of the European stock market outperforming the S&P 500 this week. This is pretty rare occasion, but there's more and more calls out there among strategists and investors to switch into European stocks going forward because they're so much cheaper than the US market.
Ksenia, good morning. Let me ask you about the way the pandemic is playing in here. Of course, we watch the latest twists and turns, the latest news lines around how different European countries are covering this. And in terms of the European equity space, do you see markets distinguishing between different performance levels or levels of lockdown, or is that a story that's come and gone?
So that's really interesting. And we're seeing that investors have really been brushing off the virus news. So overall, for example, this morning we heard that Germany is about to impose restrictions on restaurants and cafes, and we saw no reaction in the market. So far, investors' interest has really switched to the Fed, to the rate hikes, to the payrolls data that we're going to see later this afternoon. So the focus has shifted away from the virus on the optimism that Omicron is milder than expected, and also that global growth and inflation can overcome any concerns that the COVID-19 can bring.
You mentioned the payrolls report. Is this going to be a typical case of good news is bad news and bad news is good news for the market as it relates to Fed policy?
So far, there's an impression that the market has priced in the payrolls data already. The jobs report is supposed to come in very strong, especially after that really optimistic ADP report that we saw earlier. But again, all eyes will be on treasuries. Treasuries are having their worst start of the year on record. They've really been hammered. There's data from Bank of America that came in today showing that through Wednesday, again, this is before the Fed minutes came in, so a little bit of a delayed data, but it showed that investors pulled out the most money out of treasury funds in a year. That is pretty significant. So again, some people might say that treasuries have already priced in this very optimistic jobs data and, of course, Fed's hawkishness, but there's some who will say no, there's more downside from here and stay away from the treasuries.
Ksenia, thanks so much. Ksenia Galuchko, who leads our coverage of European equities markets. Thanks so much for joining us. And you can get further insights from the Markets Live team, Ksenia and her colleagues. MLIV Go, that is the function to use on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Kailey Leinz in New York. Matt Miller is off today. Now let's get to your first word news. And Bank of America is pushing back its return to office another week. B of A is now encouraging U.S. employees to work remotely through the week starting Monday while it reevaluates its next move. The bank also continued to encourage workers to get fully vaccinated and receive booster shots, although it stopped short of a full mandate. Australia says that tennis star Novak Djokovic is not being held against his will in a hotel for refugees and asylum seekers. Djokovic arrived in Melbourne to play in the Australian Open, but federal authorities overruled a state decision to let him in despite being unvaccinated. Djokovic's lawyers are trying to reverse that. Meanwhile, he's remaining in detention. Still, Australia says he can leave at any time. And you can add John Legend to the list of superstars cashing in on the boom market for music rights. Legend has sold a catalog dating back to his first album to an alliance of private equity firm KKR and music company BMG. Terms were not disclosed. Last month, Bruce Springsteen sold his entire catalog for a reported $500 million. It's a match made in speculative heaven. Meme stocks and crypto trading, GameStop is getting into the business of non-fungible tokens. The news has shares up a double-digit % in early trading. NFTs have emerged as the hottest commodity of the crypto universe. And GameStop became emblematic of 2021's turbulent year of investing. GameStop shares surging in pre-market. Well, next we get to the macro picture. We talk to Klaus Baader, Societe Global Chief Economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. And Kailey, as we head towards the non-farm payrolls, the jobs report, we'll talk more about that shortly. But we're seeing quite a turnaround in stocks. Much of the early part of the European trading morning, we were talking about negative futures in the United States, and the Nasdaq was the focus of that. But we've recently had a bit of a turnaround. It isn't all about NFTs in GameStop, surely, and that sort of more positive sentiment towards tech.
Yeah, it does seem like we are getting a little bit of a lift, up a few tenths of a % on NASDAQ 100 futures. So it's not massive dip buying we're seeing. That index is still heading for its worst week since October, but it's probably being helped out by the fact that you aren't seeing too much upward movement in bond yields at this point. My question, Anna, is 3 hours from now, when that data drops, when we get the payrolls report, are we going to be talking about a very different story depending on how strong that number is?
Yeah, absolutely. How strong is that number? And Danny, then, as Kailey rightly points out, the focus will be very much on the bond markets. How strong is that number? And therefore, how high do yields go?
Yeah, bond markets really leading this equity session that we've seen over the past week. And as Kailey mentioned, we're not seeing a lot of action right now in the 10-year yield. It is not even up a half of a basis point. We're at 172. S&P 500 futures, as we've been saying, led by tech, up 0.2%. You do have a weaker dollar headed into today's NFP report, but Bitcoin continues to see this aggressive selling, down almost 2%. So it stands to reason that if Bitcoin is doing poorly, then in terms of the U.S. pre-market session, we will see Bitcoin-related equities do poorly as well. Marathon Digital, I should point out, is lower today. Now, I want to check out the rest of the U.S. pre-market session as well. We've been talking about T-Mobile. That had warnings of growth ahead, so those shares slumped as well. For those watching and not radio listeners, we are just now seeing those numbers. And what will jump out for our radio listeners who can't see this chart is GameStop up 17.9%. It's starting an NFT marketplace, because why would a meme stock not lean into NFTs? That has the market excited. Now, I'm going to do potentially the hardest pivot ever done in talking about markets and go from meme stocks to European inflation. I don't have a segue there, so let's just go there. Just about 30 minutes ago, we had Eurozone inflation reading come in. For our radio listening audience, I have a chart up of Eurozone, France, Italy, and German CPI. So Eurozone CPI comes in this morning at 5%, exceeding expectations. We had Germany yesterday at 5.3%. A little fun fact, last time Germany had inflation such as this, the Bundesbank rate was at 8.6%. Well, let's bring in Klaus Baader, Societe Global Chief Economist. Klaus, thanks for joining us. Good morning to you. Given this picture of inflation, how much longer can the ECB afford to wait before tightening policy?
Well, I think they're going to hold on quite a long time. They are absolutely convinced that this is just a transitory phase. And, indeed, I would say that in Europe, the signs of an overheating economy are clearly less pronounced than they are in the United States. But they're not worlds apart. And so, for the ECB, there are so many steps to take before they really start to tighten policy. The ECB is still at the stage where you're talking about fading the easing, which is the expansion of the balance sheet. But I think that the evidence is becoming stronger and stronger that at the very least, when March comes around, they will stop this pandemic emergency purchase program, which was huge. In total, they're going to reach something like 1.85 trillion euros, but that they're then going to really taper very quickly. But rate hikes in Europe really look distant, at least as long as 2023. But I think that the ECB too is going to hurry up, and you do definitely see now a pivot, at least amongst the more hawkish members. What you clearly find is that the hawkish members are much more active on the screens than the doves.
Right, absolutely, Klaus. You hear a lot from them when these prints come in above estimates. You talked there about they'd be in a hurry later on. Are you concerned then about a policy mistake from the ECB? In the Fed context, we talk about how the Fed is going to have to do so much activity in a short space of time. The longer you leave it to start, maybe the more you have to do quickly. Is that going to be an issue here in Europe?
Yes, I think absolutely. That is going to be the issue. Whether Christine Lagarde and Philip Lane refute that at the moment, I think that's absolutely where the wind is blowing. This is a global phenomenon.
And what clues do you see as to just how, to use that awful word, and I'll put some money in the swear jar, that the transitory nature of inflation in the Eurozone, Klaus? What are you seeing on supply chains that either lean into or against this notion that we are going to see inflation turn around, it will have peaked, and it'll be downwards from here?
Well, you know, the supply chain issues, they obviously are temporary. They will get sorted out, but they're not going to get sorted out in a hurry because, in particular, you know, when you think about transport costs and the cost of sending a container box around the world, that's going to take a while because you're going to have new ships. You know, for me, the key really is the labor market. And here, I think the ECB is in a slightly different position than the Federal Reserve because we haven't seen the clear and unambiguous signs of an acceleration in wages that we're seeing in the United States in the euro area. Now, the trouble is, in the euro area, we've got only quarterly data as far as labor cost developments in Europe are concerned in aggregate. The kind of data that we have is not of particularly good quality. So just to put it into context, what we're seeing in Europe is that compensation per employee has rebounded to the pre-crisis trend, but it hasn't exceeded it. In that sense, the situation in the euro area is reasonably different from either, for instance, the United States or also the United Kingdom, where wages have definitely jumped above the longer run trend.
Well, let's talk about the United States, where I am, Klaus. It's Kailey in New York. And on the labor market, of course, we're awaiting that jobs report in a little under 3 hours. You say the risks are skewed to the upside in terms of non-farm payrolls. Does any number we get, so long as it is a solid number, solidify a March liftoff for the Fed to you?
Pretty much, you'd have to have another very significant disappointment like we had last month when the payrolls expanded by 200-something thousand. I mean, the median expectation at the moment is something like 435, something like that. Let's say 400 to 450. There are two advanced private sector surveys, none of which are perfect predictors. In fact, they're quite faulty predictors, but when they both point in the same direction, I think you should take them seriously. And both the ADP or APD that we got this week on Wednesday, as well as the earlier home-based survey, suggest the number could easily be twice as much. We could get something like 800,000, 900,000 increase in payrolls.
And what about the wage growth number? Do you think that the U.S. is heading into a wage growth spiral?
I think they're already there. I think they're already there. I mean, there's absolute clear evidence of a big acceleration in wage. Now, last month, we had a surprisingly low figure. It was 0.3, but actually unrounded, it was 0.26, and that was quite a change. But, you know, I mean, I have this great chart where I'm showing, you know, wages versus the pre-crisis trend, and what you see, they jump above, and then for a while, the wages basically rise in parallel to that previous trend. So just a level shift rather than a shift in the pace of growth. But for the last 8-9 months, there is a clear acceleration in wage growth in the United States. And, you know, that's not going to go away. In fact, if anything, I think it's going to get worse. Look at, for instance, the JOLT survey. I love to calculate this ratio, which is very common in Japan, which is a jobs to applicant ratio. So I look at what are the job vacancies from the JOLT survey and what is the number of unemployed. And that ratio now stands at 1.54. That means for every unemployed person that is registered as unemployed, there are 1.54 jobs out there. Workers are quitting their job at an absolute record rate. Why are they doing that? They're not doing that because they're going somewhere else for lower wages, are they?
And in this labor market, you know, as you say, a wage price spiral, we're already there, may really enforce the Fed's need to act. Of course, they themselves in the market are concerned about the return of the Greenspan conundrum of, despite them acting, you have longer-term rates start to move lower. The Fed themselves, some of them have said in yesterday's minutes that they're considering the balance sheet runoff as able to control that picture. If they pursue this instead of rate hikes, Klaus, is this enough to prevent a redux of the early 2000s?
That's a hard question. I would say yes, probably yes. However, you know, I just think that we're starting from such a massively different starting point that that bond market conundrum, I think, is much less likely to be repeated. Why do I say that? I say that because, you know, you look at the U.S. 10-year yields, it's like close to 1.8%. And at the same time, the inflation break-even market has 10-year average inflation at like 2.5%. So the market is predicting that real 10-year yields are going to be negative to the tune of, say, 0.75% over the next 10 years. I think that's mad. I don't think that's going to happen.
Adding more uncertainty to that conundrum then. Klaus, thank you very much for joining us. Klaus Baader, Societe Generale Global Chief Economist. Thanks for joining us, helping us look ahead to that jobs report. We will, this hour, also be thinking about China and its fight against COVID-19. Still with the Delta variant, of course. We'll talk to Scott Rosenstein, a Eurasia Group Senior Public Health Advisor, about the China COVID-0 policy. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Virgin Group founder Richard Branson. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. With the pandemic in its third year, global cases of coronavirus have now passed 300 million. In China's technology hub Shenzhen, authorities have said no one can leave without a negative test after new cases emerged. According to Bloomberg Economics, China's strict COVID strategy is set to inflict more economic pain on the nation. Eurasia Group has released its report on the top risks of 2022. We've been discussing those all week, and those risks include zero COVID in China. Joining us now for more is Scott Rosenstein, Eurasia Group Senior Public Health Advisor. Very good to speak to you, Scott. So we hear a lot of people saying that China is really committed still to the zero COVID policy, and that's whilst they're dealing with Delta. We all know that Omicron spreads a lot more quickly, and that seems to be the case at least. What makes you so sure that China will still stick with the zero COVID policy? Are there any signs that they could step away from that?
So it really looks like they're committed to this policy at least until October, which is when the 20th Party Congress convenes and Xi Jinping will likely get a third term. I think until then, the political importance of zero COVID is just too high. And that really leads us to believe that you're looking at, most of 2022, a year of persistent economic challenges, challenges to domestic consumption, but also significant public health challenges. Omicron is more transmissible. The appetite for any cases whatsoever is very low. Even if it is less severe intrinsically, China is likely going to find any types of increases in hospitalizations or deaths unacceptable. And that's going to lead to a continuation of this zero COVID policy, at least until late 2022.
Right, and as they focus then on zero COVID, what level of support does this kind of policy have amongst the Chinese population? One of my colleagues pointing out to me earlier on today, yes, they have these tough crackdowns, which might, from a Western perspective, look difficult to endure, to live with. But at the same time, once you're not in the eye of that kind of COVID storm, life does carry on very much as normal. What do we hear about the Chinese people's response to this policy?
It's true. So compliance is very high with the lockdowns. When they're not in lockdown, much of normal life continues. And I think one of the challenges that as we enter into the third year, economically, this starts to be increasingly challenging. You do hear, small and medium-sized businesses really struggling. They'll need extra support from the government. They'll probably get that. The population will still likely comply with a lot of these lockdowns. But also there is grumbling there. Even from the public health community, there's talk about this transition to living with the virus in China. And whenever you hear about that, it really gets shouted down quite quickly because there is so much importance on maintaining that posture. So any type of dissent, I think, will be really quiet, will be relatively quiet or silenced. And it will be, there will be enough compliance, enough political will, and the resources to really commit to this zero COVID strategy from the public health side. From the economic side, that's going to be, I think, an important piece to watch.
Well, we can talk about dissent when it comes to lockdowns and restrictions. We can also talk about it when it comes to mandates. And here in the U.S., where I am, the Supreme Court will hear arguments today on President Biden's vaccine mandates for the public sector workers and private sector workers, I should say. Is there a sense that vaccine mandates actually work, or do they hurt more than they help in that it makes people dig in their heels more?
I think the mandates early on certainly spurred vaccination. It was one of the, the only ways to get people that were really on the fence. A lot of people are already dug in. For that percentage of the population, the likelihood of mandates moving the needle that much, I think, is relatively low. But it is really still considered from most policymakers the best of a bad set of options. In places where there are really labor force shortages, there's a little bit more reluctance. In places where there's a lot more outspoken dissent, there's a little bit more reluctance. But ultimately, I think the need for mandates and the support for mandates remains relatively high because there are there are fewer tools in the toolbox at this point to really address this vaccination hesitancy issue.
Well, Scott, you mentioned labor shortages there, and obviously the CDC recommending a shorter isolation period for people who are asymptomatic down to 5 days from 10, in theory would help. But the messaging around that has been really confusing. There's been a lot of questions as to whether or not there should be a testing component. I think people just really aren't sure what they should be doing with themselves at this point. How big of a messaging failure do you think there has been when it comes to setting policy in this pandemic?
It's certainly been a big challenge. Messaging during a public health crisis is always going to be very difficult, particularly in this current information environment. The CDC certainly hasn't done itself any favors with the way that it's changed some of its messaging, the way that it's, explained or justified it. This question around 5 days versus 10 days, why we're doing it. It is, at least in part, a recognition of the economic disruption that we're dealing with. But there is also a strong public health counter-argument that you need at least some testing because there is a likelihood that people will still be contagious after 5 days. But then you get into the problem of the testing shortage. So all of these problems are compounding onto themselves, and it really is it's a difficult position for the CDC to be in right now, and it's hard to see how they get out of it during this surge because it is so explosive, and there is so much confusion already around how well the tests work. What about the rapid tests? How confident can we be in those? All of those questions, I think, are going to persist at least for the coming weeks until the testing shortage is addressed and/or we understand, Omicron a little bit better.
Well, testing is one thing. Getting people to get vaccinated is another thing. But it's also problematic if the vaccine you're getting is ineffective against Omicron. This is one of the risks you and the team at Eurasia flagged in terms of China with Sinovac. But it's not just China. 2.3 billion doses around the world, making it the most widely used vaccine. How do we evaluate that risk, given we have Omicron spreading?
So it really looks like with Omicron, our ability for the vaccine's ability to prevent transmission or mild infection has gone down a lot. It's gone down the most for the Chinese vaccines that we can tell from Sinovac and Sinopharm. And that's really a challenge in terms of responding in terms of containing outbreaks. The other big question is how well do these vaccines work against severe illness? I think we can be pretty sure that they work okay, probably much less well than the mRNA vaccines. So they still provide public health benefit. They still take strain off of the hospital. That's where we are now, but we still don't know that much. There's not a lot of data on severe illness for people that have been vaccinated with the Chinese vaccines. It would be great if we had more data on that. I think there is some hope, though, that it does still provide some help in that sense, but very little help in terms of reducing transmission. Earlier on, particularly with the mRNA vaccines, they were excellent at reducing not only risk of severe illness, but risk of infection, risk of onward transmission. And that's gone down as well. It hasn't gone down as much as the Chinese vaccines, but it is a new piece of this, of the Omicron outbreak that we need to grapple with as we think about public health policy.
Yeah, here in the West, we've got very used to the idea that there's just a lot of transmission, and we're just, you hope and you see in the data that it is keeping severe infection, severe disease, at bay. But we will watch that closely. Scott, thank you very much for joining us. Scott Rosenstein, Eurasia Group Senior Public Health Advisor. Coming up on this program, Andy Pekosh, Johns Hopkins Bloomberg School of Public Health professor and virologist. That conversation at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
We've seen, obviously, a new variant, a pretty highly transmissible variant, in combination with a period of the year where there's a lot of travel. Thanksgiving and Christmas, people wanted to get together. So the combination of those two factors really had a pretty unprecedented demand here.
Abbott, they're speaking about COVID-19 and issues surrounding it. I'm going to be focused on COVID-19, thinking about what we are watching today. I put COVID-19 very much on my radar. I mean, it's always something we're watching, isn't it? And certainly today is one of those days. U.S. hospitalization rates, certainly a real focus. If we look at the data on that, it is a bit of a worry when you look at the pace at which that has been rising up to levels we haven't seen since last winter. Also watching the restrictions then as they're coming in around Europe and the lack of response we're seeing in markets to that. So Germany, as we were hearing from Ksenia, our colleague earlier on, putting in rules around use of restaurants, and that really hasn't had much of an impact. This story not playing in the same way as it would have done in previous iterations. The China story, we've talked a lot about that with Eurasia Group, and they're not even on to thinking about Omicron over in China. They're still dealing with the Delta wave. So certainly a lot to focus on. And Danny, you focus on this when it comes to the US.
Yeah, exactly. For the US, it's not about restrictions. It is about Biden's rules over COVID vaccines and testing. Supreme Court holding a special session to hear two of President Biden's different rules. One of them, if you're a large employer, to get the shot or get tested. A separate one mandating healthcare workers to get it as well. So really, Kailey, his key push here potentially under threat.
And of course, it has implications for the labor market when it comes to these mandates. And we'll get more data on the labor market. No surprise, Jobs Day, 8:30 a.m. Eastern time is what I'm watching. 447,000 is the estimate for non-farm payrolls. But participation wage growth also going to be interesting to watch. And of course, they'll be discussing that on Bloomberg Surveillance later on with Randy Krosner of the Chicago Booth School. Of course, also a former Fed governor. So stay tuned for that conversation. From New York and London, this is Bloomberg.